Hi everybody, it's Mark O'Byrne, the Research Director of goldcore.com, your precious metals specialist. And today I'm doing a market update. You'll see from unfamiliar surroundings here. I'm actually recording from the house. It's been a momentous day on Wall Street and in markets around the world, London, Frankfurt, Paris. We've basically seen a stock market crash. It started on Monday, it's continued through the week, and it's accelerated today. And it's no exaggeration to say this is a stock market crash. And I'm going to get into the reasons why, but first of all, let's look and take stock, no pun intended, of what's happened today, because it is quite historic, and it's the biggest falls that we've seen on Wall Street since 1987. And they're saying that in terms of European stock markets, they're the biggest falls that have ever been seen. So this is, has serious ramifications for investors and for our pensions in particular. There's been a lot of people putting their heads in the sand about the growing risks in recent days, and I think, that is not prudent. So I'm going to share my screen and just briefly look at what's happened. So as I said, the Dow Jones and more importantly the S&P 500 are down 10% plus, worst day since the 1987 market crash, and European stocks closed 11% lower. Worst one-day drop ever on coronavirus fears. It's not really coronavirus fears, it's the fears of what the coronavirus will do to our already vulnerable, massively vulnerable, indebted economies, given the scale of the debt that we've been talking about this for months in our podcasts and in our video updates. So it's the worst one-day drop ever because of the dire economic outlook, because these already vulnerable economies are now hugely at risk, in part due to the coronavirus. So it's very, very, very serious what's happened today, and indeed in recent days. This has been coming. We've warned about it for a long period of time that it was coming, and it has come to pass. So the S&P 500 and 9.5% today. So this is the leading stock market indices in the world, with 500 of the largest multinationals in the world, and it fell nearly 10% today. And look at that, that's the chart there now, 10 years. So it's given up, it's 3 years. So it's given up much of the gains of the last 3 years. And that sell-off today was just, it's a 10% from these levels down to these levels. And what's interesting is that gold is acting as a safe haven again. We actually covered it this morning, how well gold was performing and how it was hedging the stock market crash. This is a chart from Bloomberg. Time of crisis, gold steady as investors weigh US measures while stocks decline. In fairness, subsequent to us doing the market update this morning, it's been such a volatile day in markets. Gold prices actually sold off quite sharply. And I think that's going to lead to headlines around the world saying that gold is volatile and not a safe haven, when obviously I think it'll be further from the truth. Gold actually fell today quite sharply, and it was quite counterintuitive. It fell. All the speculation is that it's margin calls are leading to forced selling of gold futures as investors move from gold futures to cash. But if that was the case, the S&P 500 futures are off massively overnight, massively this morning. The European stock markets opened down massively. First thing this morning, 10%. There was no margin call selling of gold at that stage. Gold actually went up slightly in the morning, and then suddenly out of the blue around 11:30 this morning, massive selling came into the gold market. So I think there's a bit of manipulation going on. Obviously, there's been proof of banks, they've been fined, they've been found guilty of manipulating the gold and silver markets. And I think that's what happened today. And there may have been some margin selling as well, but it was quite counterintuitive what happened. That suddenly, as I said, 11:30, the gold price suddenly sold off. I'll just show it to you briefly, just so you know exactly what I'm talking about. So gold on the day in US dollars, around 11:30, we've gone in effect sideways from 16 from overnight Wednesday into Thursday, we're in effect sideways, and then suddenly around 11:30, 11:40, a huge amount of selling came into the marketplace. As I said already, early this morning at age 9 o'clock, the European indices were down massively. So bottom line, the gold did fall. You can see it's down 4% in the day. But gold's up so strongly over the last year to date and last 12 months, and it was due a correction given the scale of the gain. So I think it's actually very encouraging that while stock markets fell 10%, gold only fell 4%. And over the long term, the medium term, and indeed long term, gold is performing well and outperforming most of the stock market indices. So let's just look at that briefly. So gold, let's look at the 1 day first. So today, obviously, volatility went off the charts. It spiked further 26%, and volatility has been increasing every single day, every single week in recent weeks, So gold today is down in here. So it's down 4%, as you can see. Meanwhile, the S&P 500 is down here, 11%. 11% in 1 day. Look at that. And the Nikkei down 11%. The Dow Jones 11.84. This is actually the futures. So our market's still opening, so that suggests there's further weakness there. The Russell 2000 minus 13%. The German DAX 13.37%, and the Euro Stoxx 50 13.8%. And this is in 1 day. So that's it does not bode well for investments and pensions. And this at the start of this crisis. This crisis is only starting now because it's only beginning to impact the global economy and companies' profits. And I'm not going to get into the whole. I don't have time to get into it. We'll look at it a little bit more debt in the coming weeks. The coronavirus and the ramifications for it. I mean, it's been covered to debt elsewhere, and there are. There's a lot of fear mongering, but at the same time, there are a lot of real risks, and people need to, stay calm, but be proactive, and we're going to come through this. But the people who are calm and don't panic and just are proactive and do a few prudent things will come through this better than the rest. So on a weekly basis, this here, we're down. S&P 500, we're down 17.8% on the week. The Dow Jones 19.5%. So in 1 week, it's nearly in bear market territory, which is 20%, and it is obviously in bear market territory. When you look over the longer time frame, the DAX, a German company, is down 22%. Euro Stoxx 23%. So I mean, this is very, very, very bearish indeed, and very, very worrying. And then I'll just look briefly at the year to date. Year to date, we're down 33% on the Euro Stoxx, 24.5% S&P 500. So we're in bear markets basically after the massive gains of recent years. And as I said, this is so obvious to us that this was coming. We've been talking about it for months. The writing was on the wall for a variety of reasons, but particularly because of the global debt situation, which is a global debt to GDP ratio of over 300%. So global debt is 250 trillion, and the global GDP is less than that, 1/3 of that. So it's completely unsustainable, and therefore we've built this. Since 1971, the debt has been increasing throughout the years, and particularly obviously then during the financial crisis, the great financial crisis, the debt was in effect, we bailed out the banks and the financial system, and the debt was transferred from the financial system onto the backs of the taxpayers and onto the government balance sheets, and that has never been sorted out. We all know we kicked the can down the road through the quantitative easing. Well, now we're coming to the end of the road, and it's like a giant financial and monetary avalanche. It's been building up for years, and as the avalanche is coming, and we know it's coming, and all it takes is that last flurry of snow to put it over the edge. And this virus and the economic effects of this virus are the last further snow that is creating this financial avalanche. It's upon us, you know. So yeah, it doesn't give us any pleasure, and luckily we've been warning our clients that this is coming for a long period of time. So and it is because of the debt situation, you know, and we've been warning. Even to start the year, 3 key things to protect your finance in 2020. We're talking about the importance of reducing allocations to stocks in particular, but risk assets in general. And the penny has dropped in terms of the risk to stocks, but I don't think the penny has dropped just yet with regard to the risk to bonds, and bonds are being positioned as a safe haven, and they're anything but. And in the coming months, all the same financial advisors who told people that stocks were great and economic growth is great and there's nothing to worry about. As recent this morning, I heard a financial advisor on the radio saying, "Oh, everything's fine once this coronavirus has blown over. The economic fundamentals are sound, and people should keep buying stocks." And it's crazy, you know. And these are the same people who said the same things in 2006, 2007, 2008, financially decimated their clients, you know. So yeah, bonds are far from safe because the debt is now going to be, the deficits are going to go through the roof, fiscal deficits all around the world in order to bail out companies and banks again, and ultimately indebted consumers, you know. And we're having debt moratoriums and mortgage moratoriums, and that has to be paid for by the taxpayers, you know. And ultimately, it's going to result, obviously, in currencies being debased in a huge way as we try to finance these deficits, and we electronically create billions and trillions of dollars, euros, and pounds, and other fiat currencies in order to finance these deficits, you know. So anyway, we've been talking about even financial contagion. Why is nobody talking about these risks? Prepare now, you know. Months ago, we were clearly, if you listen to that podcast, we were clearly warning about what's going to pass here, you know. And yeah, we warned about the stock market bubble. That was January 2018. At the time, the Dow Jones was at 25,000. It subsequently went up as high as 30,000 recently. So, but it was a bubble then. It was clear to see. You know, the liquidity and momentum are very powerful things, that they slosh so much liquidity in the system, and they've managed to engender this massive bubble. And it's not just a stock market bubble, it's what we have and others have called the everything bubble, because it's also in the bond market. The bonds at all-time record highs and gone to more record highs in recent days, and yields have gone even lower, you know. So bonds are in a bubble, and that's possibly the next bubble to burst. Many property markets around the world are bubbles. It is one giant Ponzi scheme, and it's beginning to unravel before our eyes. You know, it gives me no pleasure to say that, because it has real ramifications for family and friends and the communities we live in. That's just the sad reality of it, you know. So we are where we are. Let's just deal with the facts now, and the bullshit and the lies and the nonsense that goes on out there. Forgive my language, but it upsets me because you know, there's lots of simple things that people could do to protect themselves and their families and companies. But it's not even in the narrative, unfortunately, you know. So it's about time people just started calling a spade and being truthful with themselves, with their families and in their companies. And if they do that, we're going to get out of this crisis, you know. Instead of putting their hands in the sand, heads in the sand, and engaging in complete denial, you know. But this is the global debt. It's up 150 trillion in 15 years. This is the so-called recovery, you know. So it's all there. All the facts are there. All you have to do is scratch the surface, kick the tires of the car, and you'll see that the whole thing is unsustainable, and it's a Ponzi. And this virus is the straw that breaks the camel's back. So there we were, just this January 2019, talking about this global debt bubble collapse, and that's what's coming ultimately, you know, because we're seeing in the debt market as well. And I'll look at this in another day. The corporate debt market, there's huge vulnerabilities there, because the debt is just astronomical at every level of society, you know. So gold is, you know, the headlines will go around that volatile gold fell 4% yesterday. This proves it's not a safe haven, you know, and nothing refers to the truth. You look at the medium long term, 2020 year to date, there you go. Gold is up 7.7%, along with treasuries, the safest asset in the world. Meanwhile, euro stocks are down 20.7%, S&P down 14.8%. it's a hedge, it's a safe haven. That's the fact. It has been throughout history during the last financial crisis and as we go into this financial crisis. Over the last 15 years, it's outperformed most assets in the world, and it's up 9.8% in dollar terms. So, bottom line is, we've nothing to fear except fear itself. That was the quotation from Roosevelt during the height at the start of the Great Depression, and that's the truth. We have nothing to fear except fear itself. Because fear is obviously an inhibitor, and it allows us or makes us not think clearly about the risks that are there. So I don't want to add to the fear. There's so much fear out there. There's nothing to be fearful of. Sorry, there are things to be fearful of. But if you are prepared and proactive, and you give thought to these things, and listen to people who have a track record in protecting people's wealth, as an example, and protecting people's health, and you do that, then you'll come through this. But don't listen to the so-called experts in the media who have got us into this mess, because the same people who got us into this mess are not going to get us out of this mess. And the same level of consciousness that got us into this mess is not going to get us out of this mess. So, I love the quotation from Zig Ziglar, the motivation speaker, which is, fear has two meanings: forget everything and run, or face everything and rise. So we need to face everything and rise, and that's what we're going to do, and that's how we're going to come through this in flying colors. So on that positive note, follow us on all the usual channels, subscribe to our market update, stay in touch with us. If you have any questions, get in touch with us, and if we can assist you in any way in terms of protecting and growing your wealth in the coming years. That's what we've done since 2003, and that's what we'll continue to do. So thank you for your time today. All the best in protecting your health and wealth in the coming months and years. Thank you. Take care. Bye-bye.